Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you in the BNN Bloomberg newsroom. MDA Space is one of the best performers on the TSX today. You can see it's up almost 6% right now. The satellite system firm has been awarded a contract from the U.S. Missile Defense Agency for its SHIELD program. The program works on ballistic missile defense systems for the U.S. and its allies. MDA says the contract is indefinite and positions it to bid on future tasks and services to support the U.S. defense initiative. Shares of TELUS are trading higher today, up about 1.87 right now. The telecommunications giant says it has hired TD and Jefferies as advisors to help in its review of its TELUS Health unit. The company says the move will help develop monetization strategies with a focus on finding a strategic partner for the segment. Shares of defense stocks, Northrop Grumman and Lockheed Martin, are surging on comments from U.S. President Donald Trump. Trump is planning to request an increase in the country's military budget. European defense shares are also rallying on the news. The proposed increase was announced by the president on Truth Social and proposes a $1.5 trillion defense budget for 2027. And looking at the markets right now, a little bounce back now for the TSX after that off day yesterday. They're back into rally mode, I guess, maybe. We'll see how it goes for today, but it's up right now, 0.33. South of the border, what are we looking at? It is a bit of a mixed bag right now. You can see the S&P 500 about a wash right now. Dow Jones up by about a half point, and the NASDAQ is off by a half point. Well, as we continue to monitor the news coming out of the U.S. and Venezuela, Canada's oil sector continues to see some question marks on whether Venezuela's crude could compete with or even displace Canadian barrels. Let's get more on this now from Kelsey Keane, Director of Equity Capital Markets at the National Bank of Canada. Kelsey, thanks as always for joining us. Happy New Year. Last time we talked was 2025. It was about 5 days ago, but welcome back. What are your thoughts on the oil companies right now, where they stand? They took that hit.
Yep.
To start the week with everything that's unfolding in Venezuela. Are cooler heads prevailing?
Yeah, so I think, the first week into 2026, there's been a lot of news about oil, starting with, initially we were looking forward to OPEC, and now the news about what the U.S. is doing in Venezuela. I think a lot of the reaction that we're seeing in these stocks is sentiment driven. I mean, the fundamentals for Canadian oil producers are still strong.
And what gives you that confidence with them? What do you like about them?
Yeah, so when we think about Venezuela, I mean, they are also, they have a lot of reserves of heavy crude oil, and that's what Canada also produces. But when you think about the two investment landscapes, Canada is much stronger. So for those looking to put capital into an oil industry, Canada provides a lower risk market with access to global markets. And I think this is a real opportunity for our government to progress pipelines and put more investment in the industry.
And I guess, I mean, two of the big things, too, is proven reserves and fairly accurate proven reserves.
Exactly.
And it's mostly maintenance here, whereas down in Venezuela right now, they could be looking at a massive rebuild.
That's right. And if we look at what's been happening in Venezuela over the last 15 to 20 years, there's really been a decline in production. And we're looking at almost starting from a brand new place where Canada is much further ahead. But I think as we think longer term, we will see that production come online, and Canada really needs to think about progressing the resources that we have here. And
will there be demand for it the magical pipeline that everybody is Well, maybe not everybody is hoping and dreaming for, but a lot of people says needs to be built to the West Coast. Will there be demand for it? The argument has been that maybe there isn't the demand, but if we build it, will we see people coming then?
Yes, I believe so. And a lot of those exports are expected to go to Asia. And I think that also touches on another really important point here for Canadians' oil industry, is that we should be looking at diversifying our outputs or our exports. So looking beyond the U.S. To sell our resources.
And now, one of the things, I guess, a lot of the oil in Venezuela was going to China. Some of it looks like still will go there now.
Yeah.
But some of the ghost ships that was maybe going to China. Could we see Canada replace Venezuela now that maybe the U.S. is looking at Venezuela favorably? Could China be our replacement for the U.S.?
I think there's an opportunity there. And I mean, Kearney's in China now. So I think, you know, there's still a lot up in the air in terms of what's going to happen. But I think we should be looking at all opportunities.
And then just price overall for everything. Where do you see it going over the next year? You're going to put some magic ball in front of you. Here we go. Let's see.
I mean,
it's down, but a lot of them are down. But
when you say a year, that's a really long way away. Because
but what's the general direction? You're confident in it, so obviously. But the oil prices, it looks like, will remain where they're at right now for the next year or for around here, I'm guessing.
I think so, and I think we're still going to see fluctuations in the near term, just because every day there's a new development. And though I think that there's an underlying confidence in the Canadian industry, I think we have to see some more risk on go back into the sector.
Okay, and then let's make a swing over to copper. The metals have been an interesting place. Copper, gold is the sexy one. Silver's been the crazy one right now, going up and down, and copper just kind of keeps going up and up. What's going on there? I mean, it was a bit of a hoarding down in the States, but are we going to see that continue?
Yeah, so a lot of this came on the back of the news about tariffs and depleting of inventories. I think there's a broader development of electrification and industries there. So I think all of that is feeding into copper prices. It hit record highs. It came off a little bit, but I think there's still underlying strength there, and we'll continue to see some strength given those fundamentals. And
also some challenges on the other end, developing mines right now. And there's also been the strike down in Chile.
That's right. Yeah. So, there's always, when we think about commodities, we have to think about both the supply and the demand. So obviously we're seeing strong demand, and we just got to make sure that there's proper supply. And any concerns with that, with the supply right now, trying to bring new mines on? And I think, I think it's too hard to say right now, but I think that there is a focus, on producing resources, given a strengthening economy, given everything that's happening around trade. So I believe that governments globally will be putting a lot of resources into it. Okay, and just one other direction we're going to go here, just talking about IPOs and investments. You're expecting to see those jump up this year. Yeah, exactly. So I think Canada's set for a rebound of the Canadian IPO market. And for anyone who's been following knows that's a long time coming. So we're excited to see that. There's a growing pipeline of Canadian issuers looking to list on the TSX. Broader equity markets have shown strength. And there were a couple IPOs in 2025 that were successfully done. So I think that is putting us in a good position to go forward into 2026 and see some new companies list. Any particular sector is going to be stronger than others when it comes to IPOs? I think we're looking broadly across all sectors. I think thematically there's a lot of strength within industrials. Obviously, we're seeing strength in defense today and yesterday. There's obviously the AI thematic. Resources, energy right now, a bit of fluctuations, but obviously in materials, there's a lot of strength. And I think just broadly, investors are looking to deploy capital. So any company that's been showing strong, stable growth and earnings is well positioned to go public. Okay, we're going to have to leave it there, but Kelsey, thank you as always for coming in. We appreciate it. Thank you, Roger. And that was Kelsey Keane, Director of Equity Capital Markets at National Bank of Canada. Coming up, we'll tell you about new data out today that shows Canada is diversifying some of its trade, with exports to the U.S. dropping.
New data on Canada's trade is coming out today, and it appears Canada was less reliant on the U.S. as a trading partner at the end of last year. For more on this, we're joined by BNN Bloomberg's Lindsay Biscay. Lindsay, thanks as always for joining us. Numbers off, not a huge swing, but they were into the negative.
Yeah, into the negative. We'll first talk about the numbers when it comes to exports to the U.S., because that's what's kind of interesting. For the month of October, exports to the U.S. were down 4.1%. Of everything Canada exported, 67% went to the U.S. So 67%, it's still a lot. It is down by about 4% compared to the month prior. And that's actually the lowest level since this current method of calculating these numbers was established in 1997, not including during the pandemic. So this is something Prime Minister Mark Carney has been talking about, diversifying trade away from the U.S., being less reliant on U.S. for trade. And we're seeing that in the numbers coming out today, that might be the case, because when you look at exports to other countries that are not the U.S., they were up 15%. Majority of that driven by gold that was being shipped to Britain and other precious metals. That was the big driver here. Secondly, oil being shipped to China. So we're starting to see a bit of a diversification here. Most economists are saying this is like a cautious step forward. Again, it's just for 1 month, though.
And exactly. We have to take that with a grain of salt. And overall, the big picture?
Overall, the big picture, Ottawa recorded a trade deficit of $583 million Canadian. So that's actually smaller than what was expected. Most economists is expecting a deficit of within the billions of dollars, about $1.5 billion. We're still seeing imports growing faster than exports, though, which is exactly what that means. The total exports rose by 2.1%. So exports of precious metals were up 47%. And then energy exports fell 8%. And of course, we're seeing the impacts of those tariffs still on sectors that are hit hard by the tariffs, like auto, lumber, steel, and aluminum. Obviously, we're not seeing as many exports, particularly to the U.S. because of that. And then just lastly, it's not totally a rosy picture when you're looking at how many exports we have and imports throughout the year. So from the start of 2025 to the month of October, exports were up just 0.8%. So still some work to be done, potentially.
Yeah, still a lot going on, still a lot to unfold from all this.
And just to keep in mind, too, sorry.
No.
These are numbers that were delayed because of the U.S. government shutdown. So that's why we're seeing this now for October of 2025. And then the numbers for November are coming out closer to the end of this month. So just something else to keep in mind.
Lindsay, thank you as always. BNN Bloomberg's Lindsay Biscay. Well, we'll get more on the trade situation in about 15 minutes when we speak with William Pellerin of McMillan. Coming up, amid all the global conflicts and political noise, we'll get some strategic insight on how to optimize your portfolio. Well, the once red-hot housing markets in Toronto and Vancouver are at all-time sales lows as sellers struggle to find buyers. CTV's Adrian Gobriel has more.
These are some wild numbers, aren't they? Wild numbers. Wow.
Wild and worrisome.
Imagine how many more people there are here now than there were 25 years ago. Yeah, these are spectacularly low numbers.
You have to go back to the year 2000 to find Toronto home sales lower than they are right now. In 2021, sales peaked at more than 127,000. Last year, that number plummeted to roughly 62,000, according to the Toronto Regional Real Estate Board. On the receiving end are sellers like Hossein Hodadi.
It's really frustrating.
He bought and moved into the Stouffville home north of Toronto in July of 2022. Following renovations, mortgage rates spiked. He's listed the property to sell twice, once in 2024 and again in 2025. It still hasn't sold.
I'm afraid not to be able to cover my mortgage and my living expenses.
In Vancouver, the number of for-sale listings in 2025 hit a record high, not seen since the mid-90s. But sales are at historic lows. Residential sales in Metro Vancouver bottomed out at 23,800 last year, marking the lowest annual sales total in more than 20 years.
Vancouver is still extremely expensive real estate. It's more expensive than Toronto.
Sellers in both markets are experiencing a peculiar predicament.
Borrowing costs and selling prices have trended lower, and that's across most major market segments. Yet at the same time, sales were off.
Leaving many wondering what, if any, movement 2026 will bring for debt-heavy homeowners desperate to offload their pricey properties. Some housing insiders expect stagnant sales to continue for at least the next 6 months as uncertainties around the economy and interest rates remain. Adrian Gobriel, CTV News, Toronto.
Well, the headlines are loud. Venezuela continued global conflicts and political noise. How do investors cut through all of that and focus on which stocks to focus on for 2026? For more on that, we were joined earlier by Grant White, portfolio manager and investment advisor at Endeavor Wealth Management. We kick things off with how investors are navigating AI.
The conversations are largely around AI, and a lot of that is market driven. I mean, what we've seen in the last couple of years, obviously, has been driven by the AI, the AI story and the theme, and that has continued on. And so I think that's still very top of mind for people as they're considering more valuations than anything else and wondering, what comes next. And so, although the geopolitical risks I think are certainly there, and we're going to see volatility this year, it's certainly something that we're following very closely. The questions we get a lot still around our job displacement, and what does this mean for certain companies, and what does this mean if certain companies don't do as well as they have in the past, and so on and so forth. So I still think that's very top of mind, which somewhat makes sense given what we've seen in the last year to 2 years.
And what do clients say? I mean, I presume some of them have made lots of money on these AI stocks. Are they saying, Grant, should I get off the roller coaster now?
Yeah, well, it's certainly that is like, can we keep this going? Is this going to continue on? Grant, you've been a genius over the last couple of years. Are you still a genius going forward? You're right. I mean, certainly is a lot of that is like, how long can this go? We're at record highs, or is this a bubble? Is what does this mean? And a lot of the conversation we have around that relates to diversity in the portfolios. I think that's that's something you need to be very strong on today. Is that one, I think holding quality names in a diversified portfolio is going to be really important in 2026. But I also think you're going to have to look for the names that are lesser known out there in order to get good returns this year. I mean, I think the easy money's been made. I think it's going to be a lot harder for the big names that we've seen perform very well, the Amazons, the Alphabets of the world, to continue to perform at the high rate that they have or just on a share price basis. And so I think you're going to have to look for the lesser known names in a year like 2026 and see where you can find that growth going forward.
You have some stock ideas for us that you say are value oriented. Start off with Mercado Libre, which I believe is the Amazon of Latin America.
Yeah, that's correct. So Mercado Libre is it's just a fantastic business. And I think if you like Amazon, if you love Amazon, you should really like a Mercado Libre because it's a very similar business. Now, the difference is they're based out of Latin America and they have all of the infrastructure built out. So, and Amazon would love to come into the places that they operate, but it's very hard. I mean, there's a lot of moats built and fences built up, and they're not going to be able to, Mercado Libre is established. So for all the reasons that you like an Amazon, you like a Mercado Libre, but you like them even more because from a pricing perspective, they're just that much better off. They don't have the same expectations that have been built into it like Amazon has. And so you can get it. I don't know if a value is a correct way to say like they're a pure value stock. I don't think that's the case, but they are value at a reasonable price, or a growth at a reasonable price, I should say. They're a high growth company, looking at annual revenue growth over 25 to 30% per year. And so we expect that this company is going to produce, 50 to 60% in overall gains in the next few years for us. And I think that, based on what we're seeing from them, that's a very likely scenario. You have a New York listed company, CNX Resources. What has caught your eye there? Yeah, this is, again, on the AI theme, energy is obviously one of the big conversations we have on a regular basis with clients, actually. And so CNX Resources is a very interesting company to us because, again, it's a lesser known name out there. One of the things that I love about this company is, their management, their market position is also fantastic. They're more of a midstream. They control like the early and midstream of the energy production. They're located in Pennsylvania, and so they've got their geographic location is actually really strong, really perfect for this. And they've shown that they can manage through price pricing issues, and still generate strong free cash flow. And I think they've got 23 straight quarters of free cash flow growth going on right now. So overall, the company is very strong. Management's been very strong. Again, I just expect that they're going to be able to continue to do well as energy demand continues to increase. And especially on the natural gas side, I think CNX is going to do very, very well.
And finally, a Toronto-listed name, Cipher Pharmaceuticals. Their specialty is niche drugs. What draws you to this one?
So Cipher is just, again, on the theme of looking for lesser known companies that you can find great value in. Cipher is a really good example of this, because out of all the pharmaceutical companies, you're looking for, like, people would be aware of, Cipher's usually not on that, on a big list. And part of the reason is they're not focused in on the big drugs that everybody else is, like, that this you'd see commercials for. I mean, this isn't a company that's going to be producing like an Ozempic or something like that. They don't get into the mud of like trying to, of funding big research budgets and so on. What they're very, very good at is identifying niche drugs around things like, like skincare and acne and things like that, that are a high need, but just not high priority on the big list of drugs. And so they're able to squeeze out very nice margins on higher volume products that are just lesser known. They're also very good at structuring. So for example, they're very interested, rather than getting into research projects, they're more interested in buying up something where they can license it out to American companies, and those American companies can then go and sell it for them. So they're just essentially clipping the margin in those types of deals. So overall, I'd say, again, this is more of a very strong play from a strong management team. They've been very good at this for a long time. And if you're looking for a good company that's somewhat lesser known, you can find good value. And I think Cipher is a very, very strong company in that space. And again, good, strong year-over-year revenue growth, and we expect that we're going to see a 40 to 60% share price appreciation sometime in the next 5 or 6 years, perhaps, on that one.
And he was speaking with Grant White, portfolio manager and investment advisor at Endeavour Wealth Management. Coming up, Canada's merchandise trade balance swung back into a deficit. We'll have more on this after the break with William Pellerin, an international trade lawyer with Macmillan. Canadian exports to non-U.S. countries saw an increase in October. Data from StatsCan shows total exports rose 2.1%, driven by gold shipments, specifically to the U.K. Meanwhile, the value of Canada's exports with the U.S. fell to 67.3%, the lowest level on record outside the pandemic. Imports were higher as the country brought in record shipments of computers and computer parts. Smartphones and industrial machinery and equipment also drove that increase. MDA Space, a star performer on the Toronto Stock Exchange for today. It's up more than 6%, 6.4%. Satellite system firm has been awarded a contract from the U.S. Missile Defense Agency for its SHIELD program. The program works on ballistic missile defense systems for the U.S. and its allies. MDA says the contract is indefinite and positions it to bid on future tasks and services to support the U.S. defense initiative. ExxonMobil says lower oil prices impacted its fourth quarter results. The oil major expects a hit of 800 million to 1.2 billion US, and says lower chemical margins and asset write-downs were also a drag on profit. The company is the first of the oil supermajors to report quarterly guidance weeks before earnings season is set to start. U.S. President Donald Trump is urging Exxon, along with rivals Chevron and ConocoPhillips, to invest billions to revive the Venezuelan oil industry after the ouster of Nicolas Maduro. And taking a look at the markets right now, TSX back into the green after that rough day yesterday and a little bit of a shaky start this morning. It's up 0.36%. And looking at the U.S. markets, it is a mixed bag. The S&P 500 pretty much a wash, off slightly, but a wash. Dow Jones, it is up almost 0.6%. Going the other way, the NASDAQ is down 0.68. Latest data shows Canada is becoming less reliant on the U.S. as a trading partner. This comes as the value of Canada's exports with the U.S. as a share of total exports Exports fell to 67.3% in October, the lowest level on record outside of the pandemic. And let's get some reaction to this from William Pellerin, partner at McMillan LLP. William, thanks as always for joining us.
My pleasure, always.
Let's break down the overall number. What do you think of it? And then we'll turn to the U.S. That share dropping down to 67.3%.
Yeah, so I think we're still seeing, Canada facing strong headwinds and diversifying exports. This is a good first data snippet. If it's driven by one commodity, it's hard to see if it's a broader trend that's starting. Certainly, the Prime Minister and the Government of Canada has been working very hard to push towards diversification into new markets. We know and we hear from our clients that that's a long-term play. Of course, you have to build new customer relationships, go to the trade shows, and do everything that you need to do in most cases to go into foreign markets. So certainly on the commodity side of things, that's easier. These things trade easily. So we're seeing that perhaps with gold. We may see it in other sectors more quickly. So I think a net positive for today, and we'll see whether that's a forebringer of things to come.
And now gold, you mentioned, was a big part of that. What happens if you take that out of the mix? How does it look?
Yeah, that's right. So, we haven't played around with all of the data yet. This just was released, but ultimately, that's what we're seeing is it seems like a little bit of a one-off. Some gold shipments to the United States going to the UK instead. On the overall piece, at least anecdotally from clients, it's not happening yet, that broad-based shift in exports. And in fact, right now, it's more about circling the wagons than anything else, particularly on those Canadian businesses that are exposed to the U.S. market, that have historically been captive to the U.S. market. It's more about survival before we can diversify exports, right? They need to get through this valley where we're seeing clients lose access to the U.S. market due to those sectoral tariffs. For example, in the wood products space, kitchen cabinets and furniture and the remainder in lumber and the like. And so they have to get through this valley before they can even think about, growing the business elsewhere, whether it be Europe or Asia.
And it's a struggle for them, talking about the cabinet makers. Trump saying he's going to defer for a year on that tariff on them. And of course, the wood shipments, the U.S. is their big market. They need it, but also the tariffs are hitting them there, and they don't know how do they make decisions on what to do. I guess this is a tough point for them.
Yeah, it's very difficult for folks in that space. They're really getting hit with a 1-2 punch, right? So you lose access to the United States market because of a 25% tariff. And you're absolutely right. The tariff was supposed to go up to 50% on Jan 1st. For now, it's staying at 25%. That's still a devastating blow. And perhaps the second part, so that's the first punch, is losing access to the U.S. market. But the second punch, and perhaps the one that hurts the most, is we have to remember that the entire rest of the world has also lost access to the U.S. market because of that tariff. And they're looking for a home for their products. And so we're seeing a rapid increase in imports into Canada for products that historically were going to the United States. So whether it be, Malaysian kitchen cabinet manufacturers or Chinese or otherwise, flowing into Canada. And so that's kind of the idea, and seeing that shift in trade flows where Canada is becoming far more attractive at lower pricing in many commodity goods and in many manufactured sectors.
And now you mentioned that valley. Are we still going down into the valley? Are we in the valley, or are we starting to go back up the hill? Does it feel like?
I think it's still getting worse. So now we have the import-export data from StatsCan for October. But remember that the tariffs on wood products that the U.S. imposed went in place only in October. So the November data, the December data, the January data, when it comes out, I think is actually going to show a further erosion of sales and exports to the United States across a broad swath of sectors. Probably the same for steel. And we're going to see a rise in imports into Canada, which will further play with that trade deficit number into November and December. So, picture that movement away from the United States because of those sectoral tariffs, and then we're going to start seeing perhaps a diversification of exports over time for those companies that can make it through the valley.
All right, and for imports, we saw an increase, electronics, industrial equipment as well. Is that a good sign for what our economy looks like?
In a sense, I think that most economists would generally agree that if there are massive investments and electronics and the like, it depends on what the numbers actually reveal in terms of those types of electronics. If it's all consumer, then it's driven by the holiday season coming up and the like, then it's not necessarily a major move. On the other hand, they're not necessarily goods that we're making a lot of in Canada that's displacing exports, for example. So that could be a net positive. And if it's for investments into Canada, capital equipment, CapEx and the like, then that's a very positive sign. So there seems to be some bright lights in that data that we're going to be unpacking with clients and seeing what we've seen. But it's a little bit too early to tell. And I think November and December are going to be really the critical months to look at also.
Okay, we'll wrap it up there, William. Thanks as always for joining us. Happy New Year to you.
My pleasure. Happy New Year.
William Pellerin is a partner and international trade lawyer at McMillan. ExxonMobil is forecasting lower fourth quarter earnings on falling oil and gas prices. We'll talk about that after the break. ExxonMobil is forecasting an $800 million dip in the fourth quarter earnings due to falling oil and gas prices. The announcement comes before an earnings season for oil companies amid major changes in Venezuela. Here to talk more about that is Peter McNally, Global Head of Sector Analysts at Third Bridge. Peter, thanks as always for joining us.
Yeah, good to be here.
Nobody's hitting the panic button just yet, are they?
No, I mean, look, it was about a $5 a barrel drop in the oil price that we saw from the third quarter to the fourth quarter. Exxon got a little bit of a tailwind from better refining margins. It looks like on the whole in the fourth quarter, but not enough to offset what was just a weaker. And that's pretty typical that we get a seasonal dip in the fourth quarter just with some weaker demand, in the oil price. But the big picture here is it's not changing Exxon's long-term investment outlook. They reiterated that about a month ago. They're spending a lot of money, relative to recent years, but it more reflects the opportunity set in front of the company today.
All right. Now, you said there's a fairly typical dip. Any outside forces, though, beyond that?
Well, I mean, look, the consensus is that the oil market's been oversupplied, and we would agree with that. Mm-hmm. The doomsday scenarios that have been out there where oil was going to crash into the 40s don't seem to, have occurred. Demand has proved to be a bit more robust, I think, than people, expected. OPEC has stopped increasing production again at least for the time being, at least through the first quarter. So some of those forces working against oil maybe easing up a bit. And now, we've got an even more dynamic, let's call it geopolitical environment in front of us.
Dynamic is a nice word to use there. Venezuela would be one of the dynamics. But what other places should we be looking at or paying attention to?
Well, I would say if we roll back a few years ago, the biggest source of non-OPEC supply was here in North America, the U.S. and Canada, and that has changed. And we've seen places like Guyana grow, Brazil grow. There's a lot more oil, in particular, coming out of South America, maybe than any other place in the world outside North America. So those dynamics have really sort of changed the equation for OPEC and other producers that maybe we were paying a bit closer attention to a few years ago.
And what kind of an impact are they having places like Guyana and Brazil is looking at growing as well? I mean, Guyana's smaller, but they seem to have found their little spot.
Well, they have a great geography, right? It's easy to access both European and Gulf of Mexico markets, right? Refiners need that crude, and both Europe and the U.S. Are just the largest markets in the world for fuels. So being, in the northern part of South America there provides a real advantage for Guyana, and it's gone from, 0 to about 700,000 barrels a day, which is, really material. And by the end of the decade, or maybe even sooner, Guyana was on track to overtake Venezuela, their neighbor to the west, founding member of OPEC, home to some of the largest oil reserves in the world. And it has been quite a growth story, and one that Chevron, found incredibly attractive. And that's really the primary driver why Chevron acquired Hess, is to get in on that resource. At the same time, Brazil emerged starting, 2007, 8, 9 as a large potential growth in oil supply. And that's really started to materialize here this decade.
All right. And you mentioned OPEC. They're going to pause at the output hike. They announced that. What kind of an impact will that have?
Well, seasonally, and they've been through this several times, or for a long time. Q1 is a weak demand quarter, so they're pulling back. But after years of trying to balance the market, which they've been largely effective at doing since 2017. OPEC is pulling back on the increases that they had ceded to other countries, and regions around the world, starting in 2024, really. But we're on a pause right now for those increases.
All right, let's bring it back full circle. Earnings season's coming up. What can we expect?
Look, I think that the outlook for energy companies is going to be pretty muted. I would not expect any big changes to investment plans. The commodity backdrop is just not that attractive for big, changes or upward changes, to investment. That said, here in North America, whether it's in the U.S. or Canada, the oil producers have been able to grind out more efficiencies. And production has proved to be a lot more durable than I think than the consensus thinks. So it's pretty much a status quo, is what I think going forward. As we started with the $5 drop in the oil price isn't going to impact that much when it comes to investment plans.
And with the outlooks, would Venezuela is it possible to even start to factor that in, or no? It's still.
I think it's a little, it's a fluid situation. I would put Venezuela now maybe in the category of countries that could potentially grow production in, starting late this decade or even beyond. It's the security situation is the biggest problem there in a country that's got a lot of problems. But Venezuela is going to require tens of billions of dollars to develop. But there is a large resource there. There's no, the country has produced a lot less than its potential over the last 25 years.
Okay, we'll leave it there. Peter, thanks as always for joining us.
Good to see you.
Peter McNally is Global Head of Sector Analysts at Third Bridge. Coming up, more on the energy sector. We'll get insight on investing in Canadian oil and gas stocks from portfolio manager Rebecca Telcher. Well, the U.S. continues its operations in Venezuela as 2 more oil ships were seized by the United States. CTV's Joy Melvin has the latest.
Dramatic pictures posted by the Trump administration show the U.S. Coast Guard boarding a Russian-flagged oil tanker after chasing it in the North Atlantic for 2 weeks, risking a conflict with the Kremlin. Moscow officials angrily called the U.S. seizure outright piracy. Another vessel captured in the Caribbean, U.S. forces seen rappelling onto the deck of an empty vessel called the Sophia. Both ships described by the White House as dark fleet tankers illegally transporting sanctioned oil.
So our military is prepared to continue this. As he said, the president, when he speaks, he means it. He's not messing around.
It comes as President Donald Trump says he's in charge of Venezuela and will control its oil after America's high-risk military mission to arrest Venezuela's dictator, Nicolas Maduro, to stand trial in the U.S. for narco-terrorism. Trump says Caracas will turn over 30 to 50 million barrels of oil to the U.S., giving the administration tremendous leverage to force the socialist government there to become an ally.
We're going to sell it in the marketplace at market rates, not at the discounts Venezuela was getting. That money will then be handled in such a way that we will control how it is dispersed in a way that benefits the Venezuelan people, not corruption, not the regime.
After a classified briefing, several lawmakers are critical of Trump's attempt to reshape the world order.
This is an insane plan. They are talking about stealing the Venezuelan oil at gunpoint for a period of time undefined as leverage to micromanage the country.
The president says he intends to maintain significant control over Venezuela's oil industry, meeting with top U.S. oil executives Friday to restart U.S. drilling there.
CTV's Joy Malvin. For more on the concerns of the Canadian energy sector might have regarding a major hit from the newly unlocked Venezuelan crude, we spoke with Rebecca Telcher, Portfolio Manager at New Haven Asset Management.
The infrastructure, the North American infrastructure is so complex and embedded that it makes actually, displacement is not easy. First, there's so many more questions than answers right now as it relates to Venezuela. And it's interesting to see the market react so sharply when there's still so much unknowns with regards to, the market's been up since the beginning of the year. The only sector that's really been hit are Canadian oil stocks. And so, there's clearly the market thinks that there's this risk that Venezuelan oil can displace Canadian oil. But if you actually look at the facts and the underlying fundamentals, I don't think this is a risk in the next few years. There's, so my first question is, what is Trump actually going to take over the oil production too?
He's now saying indefinitely. They're going to run it indefinitely, whatever that means.
Whatever that means. More questions than answers. How is that going to happen? What's going to happen at Congress? But regardless, even if that does happen, the estimates I'm seeing are $50 billion to in the hundreds of billions of dollars of investments over the next 15 years just to get, production back to 3 million barrels a day versus, less than 1 million of what they're producing now. The question also is, do these U.S. producers even want to go in given the heightened geopolitical risk?
The expense, just the expense alone.
So do they want to be investing capital in a country that they don't know who the leader is right now, and they don't know, if Trump leaves in 3 years, are those policies going to continue? I don't know if they want to. A lot of these U.S. oil companies have their hands full in U.S. shale right now.
What kind of incentives do you think it would take from would the American government offer incentives to get those companies back in? Chevron's there already on a reduced rate. To get them back into Venezuela, or is there even enough incentives to convince them that it's worth it? They got burned once.
Yeah, exactly. I'm not, I really don't have the answer to that question, but it is a valid point of, if they have the appetite to do it, maybe with the right incentives. But again, even with the right incentives, all those incentives can roll off, as the presidency comes to an end. So, that's the Venezuelan part of the question. And then you look at, Canada and what we produce. And so, our oil pipelines are full right now. You have oil going from, Canada to the Gulf Coast, but you also have oil going from, Canada to, let's just say, the Chicago hub area. Right now, there's the existing pipelines that we have. There's no pipeline to pipe Venezuelan oil from the Gulf Coast to the Chicago area. Those pipes are no longer in service. So
they would just be down on the Gulf Coast.
Exactly.
Gulf Coast,
so again, it's really complicated. Canadian oil, I think competes internationally. We talk about oil sands, but the CapEx is really spent up front. And so the ongoing maintenance CapEx is actually very low given where the Canadian dollar is. I think Canadian oil is very attractive. There is a logical buyer. Canadian companies have been living through, austerity through, government policies for the past decades. They've gotten really efficient over the past 10 years with lower oil prices, and they continue to thrive. So
could this lead to more investment, you think, in Canadian oil?
Well, I do think that this could lead. This brings the case to make a new pipeline, as we talked about previously, that if Carney is looking at the reliance on our exports to the U.S., I think this brings a really valid a case for a new export pipeline to Asian markets. If we do think. And again, I don't think this is going to be in 1 year, and I don't think it's even going to be in 3 years. If this happens and there is some kind of displacement of Venezuelan oil, it's going to be, let's just say, 5 to 10 years. Can we build an export pipeline in the next 5 to 10 years to displace whatever, incremental Venezuelan oil the U.S. takes? Yes, I think so. So I don't think Canadian oil is at risk as long as Canada plays it smart and we make the right moves. There hasn't really been that much.
That's the problem. Is there the political will on all levels?
Again, we have a new prime minister who seems to be, business friendly. He's saying the right things, and I think, if this Venezuela, momentum of U.S. taking over their oil continues, I think this actually pushes Canada in the right direction to get that pipeline built and fast.
That was Rebecca Telcher, portfolio manager at New Haven Asset Management. All Market Call is coming up next, and today on the show, we have Stan Wong, portfolio manager at Scotia Wealth Management. His focus, North American large caps and ETFs. Let's take a quick look and see how the markets are doing right now. On Bay Street, it's a bounce back from yesterday, and the strong start to the year continues. The big index moving right now. Materials for the year is up 5.64%. Healthcare also up 5%. Those are some of the movers right now. And Wall Street, well, it's a wash on the S&P 500, and the NASDAQ is down by 0.55. Thanks for watching Morning Markets. We'll see you back here tomorrow. Have a great day.